What's up, everybody? Welcome to another episode of Tequila Tuesday, brought to you by our friends at Sendoso. Shout out to my guy, Danny, over there representing Sendoso. I see you, dude. Appreciate you. We are here today to talk to Kossack, who is the co-founder of Aspireship. And, we talked a little bit about like all the different things you need to learn as you go through your career as entry level, maybe SDR to AE to manager to VP. And one of the things that doesn't get all that much attention is equity and stock options and all this kind of stuff. And I keep bringing this stuff up because I know that all of you are out there working and have opportunities to earn this stuff, and your companies don't talk to you very much about it. Your leaders don't talk to you very much about it. And Corey is one of the few people on LinkedIn, especially in my opinion, in a founder role, who tells it like it is, who constantly creates content around stock options and equity and what is true and what is false and all this kind of stuff, which I really appreciate the transparency and leadership from him. And they've also at Aspireship debuted a new program for sales managers and sales leaders, which I wrote about yesterday. I believe you should take a look at that. So Corey, turn it over to you, man. And appreciate you spending some time with us.
All right. Thanks so much. This is fun. Thanks for having me. And thanks everyone for joining live and everyone who's going to be watching after. So I don't know how these typically go, but my guess is that this will be a little bit different in that I'm going to force Scott to talk to me, and I'm going to force others on this call to talk, ask questions, chime in, all that stuff.
I like the part where you force everybody else to answer.
Yeah, absolutely. Yeah, I'm very forceful. So the reason is that I have no slides. I have no presentation. It's just not how I like to do things. But in terms of my experience with this topic, I've been a founder multiple times. I've been through 3 exits. I've raised capital. I've, created stock option plans. I've done all of those things. And I've experienced a lot of stuff around it. And more specifically, I've talked to a lot of people that just have absolutely no clue what these even mean and what can happen. And even Scott and I won't always agree on what is true and what isn't with this topic, in part because we've sat on different sides of the table, right? So I've been in the founder role, and Scott's been in like VP of sales roles and stuff like that at companies that raised a lot of money and exited for, I think hundreds of millions, if I remember correctly.
Yeah.
And you're like, hey, where's my money, right? And so it's a very interesting topic. So there are so many things we can go into with this. We also have something in our video library, Stock Options 101, we did with a VC, my VC, who also was a lawyer. It's really good, and he probably does a better job than I will explaining it. So that's there as supplement. But what I thought I would do is start with, well, first of all, maybe we'll do this interactively and ask in the chat. How much does anybody here know about stock options? Anything you can throw into the chat, just give me a basic frame of reference. Should I start from the absolute beginning, which is kind of what I'm planning on doing?
Yeah, I'll chime in while other people are maybe thinking or talking, but I've had stock options as an operator a half dozen times. I currently have stock options in dozens of different companies that I've either advised or invested in and whatnot. Been through the exit process a couple times, never been through an IPO process before. That part would be new and different for me. I think that most people, Corey, here, and it looks like the chat is kind of in alignment with what I'm listening to, are really at like 101, maybe 201 kind of, level. And I think one of the things that was a big deal to me when I first got going was, what does it mean in terms of what it's worth to me now and what it might be worth to me in the future? That's the part that I wish somebody just brass tacks told me straight away. Right. And then I think there's also, you could get into kind of what to ask for in different roles, what's normal, what's fair, and why. I'm an SDR. Do I deserve any? How many? I'm an AE. I'm the first AE. I'm a sales manager. I'm a VP, that type of thing. So that's my kind of angle. Anybody else, feel free to chime in.
Yeah, I definitely see a bunch in the chat. So that gives me a great baseline, which is basically the beginning, or I know a little bit, which is most everybody in the entire world, by the way, right? Even people that have been executives and all that stuff, you know, all of those things are interesting. So starting at the very beginning, I think it's important to understand, how do these stock plans even get formed? What happens when a company is founded, right? So when a company is founded, a founder or set of founders, they go and they file incorporation paperwork, right? And that incorporation paperwork has an arbitrary number of shares. You could pick any number of shares you want. I could say, I want 1 billion shares in my company, and that would be fine. I could do that. But what's kind of standard, or at least used to be standard, and is my version of standard for as long as I've been involved in this, is like, you start with like 10 million shares in the company. And when you do that, you're like, okay, we have 10 million shares in this fake company that does nothing today. Whoever the founders are, they either divide those shares equally, or there's a weighting between founders, you know, one has more or whatever. And basically you distribute all of the shares of the company on day one, right, to those people, with one exception. And I'll get to, I see Dale's question, we'll get to that in just one second. With one exception, and that exception is, if you're a smart founder, you set aside a stock option pool. Oh, sorry, gotcha. All right. So if you set aside a stock option pool for your future employees, and you do that day one, not having to go back, you know, later. And so that's what I would do, and that's what I have done when I start companies. Is, okay, there's 10 million shares. You know, the vast majority are going to, you know, founders or founding team. And then you have the stock option pool that's reserved out of those 10 million, let's call it 1 million shares out of the 10 million, that are going to be available to issue to early employees and employees as you go on, right? So that entire amount of shares makes up the company. And so you place a value on it on day one. It's fictitious. You're like, hey, it's like a, you know, 1/1,000,000 of a penny or something. It's what these shares are worth. And then as a founder, you pay into that and say, all right, here's my like $12 for my millions and millions of shares of this company that I think are going to be worth lots of money one day. But today I'm saying this is what it costs. And from there, you go out and try and create a business. Sometimes if you're an experienced founder, or you're just really good at convincing people to give you money, you raise money right away from others. And if you're raising money, that money issues new shares in the company. I'm not going to go into all the math of like each time you issue new shares, what does that look like and all that stuff. But essentially that 10 million shares becomes something more than that, because you raised capital. So that capital, instead of consuming the existing shares, they have to issue new shares, and that's why they call it dilution. That the pie is bigger, but your relative share of the pie is smaller.
Corey,
yeah.
Can we pause on dilution for a second? Because I saw that a couple times in the chat. One of the things that would be cool to learn about with dilution is how much is expected at each particular level. If I'm in there before Series A, what is that dilution going to look like for me? Series B, what would it look like? Series C, what would it look like? Anything you can add there about dilution?
Yeah, great question. And before I answer, I will answer, but before I answer, the way to think about this is that companies largely will have lots of dilution, startups especially, that are going to raise multiple rounds of funding, but not everybody does that, right? So we're sort of used to this, and we're conditioned to read it because we see it all the time. that, okay, first comes angel money, then comes a seed round, then comes a Series A, then a B, then a C, then a D, and they just keep going until IPO. Not every company does that, right? And so like there are companies, including a number of companies that Scott has been a leader at, that have gone on that track, and they end up raising $50 million, $100 million, $200 million or more in funding over many, many rounds. At each round, you should expect 20 to 30% dilution. So 20 to 30% of the company is essentially going away, or it's expanding by that amount. So your relative amount is like that at each turn. So you could start with that 10 million shares that I referenced, and when it's all said and done, you could have 100 million shares in the company. So the simple way to think about this, before everyone's head starts spinning in the math and trying to like carry the ones and all that stuff, is that if you get 100,000 stock options in a company that has 10 million shares, that's what, 0.1%? Did I do that right? I think so, right? So if you take that and it starts there, you stay with that, let's say 10,000 options or 100,000 options, whatever I said. And when the number of shares multiplies, the percentage that you own is much, much smaller. In theory, you're owning something that's much, much smaller percentage-wise, but it's a much larger number. But that's sort of the way you can think about the dilution part.
Any other questions on dilution? Mike Simmons, I know you had mentioned that specifically.
How do you solve for that dilution at each round, like as an executive inside the organization, or do you expect an additional grant, or do you want to have all of that factored in throughout the whole during the initial negotiation, like expected number of rounds?
Yeah, so it's a great question. And hey, what's up, Mike? Great question. The way I think about it is you should never expect anything, but you can always have the opportunity to earn more. And if you're really important to the company, depending on how funding goes and whether or not it also depends on whether or not things are good, right? So it's one thing to have dilution happen where you went from 10 million shares to 100 million shares over 5 years, but the company is worth crazy amounts of money and it's just going. It's another thing when things start to go sideways, which happens all the time, and your ownership, relatively speaking, is getting smaller and smaller, and the pie isn't as big as you thought it was. So that's another thing. But yes, you can always, everything is negotiable, right? It depends how many options are available. Once a company runs out of options to issue, you have to go back to the board and get the board essentially to dilute the entire shareholder base to issue more stock options. So it gets hairy very quickly if companies run out. But the bigger thing I want to, nobody likes to do that. It's challenging for a lot of reasons. But
I like to do it.
The thing I want to impress that I want to impress upon all of you, because this is probably the biggest thing that's misunderstood, and why people get shocked when a company sells for hundreds of millions of dollars and their stock options aren't worth anything. And the biggest thing is something called a liquidation preference. So what happens when you raise capital from investors is they get what's called preferred shares. The founders and all the employees, including everyone that gets stock options that then end up converting into stock, they get what's called common stock. So it's like common stocks like here and preferred stocks right here. And basically what preferred stock gets, they sometimes get other voting rights and things, but the biggest thing that they get is something called a liquidation preference, which is usually, you could be in a multiple, but it's usually a 1x liquidation preference, which essentially means if I'm an investor, call me a venture capital firm, and I give you $100 million to go grow the business, and everyone goes, yeah, we raised 100 million, we're going crazy, we're a unicorn, whatever, all this stuff. And someday later, the business sells for $100 million. That's the actual market cap. That's the valuation of the company, which is not a bad, I mean, $100 million business is nothing to sneeze at. I mean, that is hard to do. So if that happens and the business sells for $100 million, 100% of the money goes back to the investors on that 1x liquidation. They basically have a right to do one of two things. They can either take their money back at 1 times the amount of money they put in, sometimes in really extreme circumstances or different economic periods, which we're going into an interesting one and we can talk about that. There's things like 2x liquidation preferences where they can get double their money back, or they can choose to convert into common stock, which basically means that they get what they should have gotten for investing in the company. If they were going to get 20% of the company, they convert to common stock and they get 20% of whatever the value is. The trick with this, especially with all of these mega rounds and how big venture funding has gotten, is that at each round, you're essentially doubling down. And if the value of the company does not multiply as you take this new funding in, then you end up in a scenario where everyone, including the founders, gets zero. Now, that's the extreme example, although it happens all the time.
Happened to me once.
There's a different example. Yep, there's a different example, and I'll stop for questions in a second. There's a different example that's a little less extreme, where it just reduces the amount of money that's available for distribution. So if you, thinking back to the dilution question, like, oh, I own, I think 1% of the company today or whatever, you know, if it sells for $100 million, I'm going to make $1 million. Yay. Like, you know, you have that in your mind, right? If in this example, there were 50 million raised and the amount was at a valuation that was steeper or close to what the actual valuation of the company is when it either gets sold or goes public, then basically that 50 million comes off the top and then there's 50 million left to distribute. So it just sort of reduces things. And that's something that happens most often. I have another point to make about the stock option layer of this, but I'll stop for a second in case there's questions on this specific thing.
Alex had some questions about some of this. I don't know. I don't see him anymore.
Yeah.
Oh, go ahead.
Hey, Scott. Hey, Corey. First off, thanks for doing this, Corey. I just generally, like, I have zero clue about stock options or RSUs, and I was offered that at a separate startup. But my question is more so, if you're looking at it from an IC versus leadership perspective, in terms of like, what are the differences between like stock options? Like, kind of what would differ with those if you were, say, maybe a founding AE versus maybe a founding, I don't know, VP of sales or a sales manager or an SDR manager. I don't even know if that might be a thing, but yeah, if you can kind of touch on maybe the differences in those two, that'd be awesome.
Yeah, absolutely. So the way I think about it is that there are no rules. There are no rules to this, all right? So if I'm a founder, and which I am, and I go through this process, in the very early days, that's, to me, that's the time. If you're trying to do something with this where it is financially lucrative, I'm all about the very early days, because that is really the only time from my perspective where it could be a really big hit. People have differing perspectives on that, but that's my perspective. And part of the reason is not just, you know, if you start in the beginning, the company might be worth, you know, $5 million or something. And if it becomes something really big, you know, it can multiply 10, 20, 100, you know, times that amount. But aside from that, in the really early days as a founder, you typically have this pool of stock options. Again, I'll call it 1 million shares. It might be 100,000 shares, could be anything. But whatever it is, you've got this pool of options and you don't really know how many people that needs to serve. Like, you think in your mind, well, you know, I'm probably going to go 2 years before I raise around the funding. And so I want this to last me that 2 years. And I'm probably going to hire 5 to 10 people. And you know what? I want to be generous. I've seen people get screwed before. And like, I want to pay back the people. Again, not everybody's like this, but like a lot of people are. Like, I want the people that are in early and with us to like really win on this. So we're going to issue, this amount. And most of the time, it's just completely arbitrary. And at that stage, there's no boards involved. There's none of that stuff. It's just like, yeah, here, let's give them 50,000, right? And so that's the time. Once you get to, again, I keep picking on Scott, but it's really, Scott has been in the Series B, Series C, and later companies. When you're at that level, it is very regimented. And typically it's like, yeah, we have bands for this where, SDRs get nothing, or they get 3,000 shares or whatever. And then, typically at leadership levels, if you're not talking about executives, but you're talking about like managers or directors, if I were to pick a number out of Sky, it's probably 10x that amount, 10, 15, 20x what individual contributors are getting. I don't know, Scott, what's been your experience in the difference between IC and sort of leadership, non-executive, because executive is a whole different ballpark.
I talked about this. I've talked about this a few times, and I try to make it somewhat comical to deal with the pain that we all may experience. But if you're an individual contributor, best case scenario on a really, really successful exit to me is like you can buy a new car. The joke that I make is like, congratulations, you could buy a new Nissan Leaf. You make like 30 grand. If you're an SDR or AE, like, fuck yeah, we're $1 billion unicorn. Unless Alex, you get a new, all black Nissan Leaf. Congrats. Golf clap. If you're a sales manager, maybe you can get like low 6 figures. So now you just put a down payment on a house. If you're a VP, you're hoping for a 7-figure kind of payout. Oftentimes, Corey mentioned at the beginning that I had a couple $100 million exit. That couple $100 million exit, I made like mid 6 figures. I didn't even get a 7-figure payout. I was a VP of sales. That was the 4th time I had been a VP of sales. I had 1% plus of the company at one point in time. So like your company has to be very, very successful if you're a non-founder to make like life-changing kind of money. You compare and contrast that to what a founder might take home even after all of this other stuff. The discrepancy in what you take home versus value you perhaps have brought to the table, the value discrepancy is massive. And Corey and I may or may not disagree on if the gap should be that big, but that's kind of how I've articulated it before and what I've seen.
Yeah, thanks for sharing that.
Yeah, I think
really put. Sorry, Corey.
Yeah, absolutely. That's great. Couple things I would say, and I'll stay away from like what should or shouldn't be, because we could get into very long philosophical conversations about this kind of stuff. We'll try and focus on what is or what likely will be to help everyone here. But here's what's really interesting, and nobody talks about this stuff. I just happen to know because I went through it, where I had a very early exit, right, where the company raised less than $1 million in funding total. And we had a very early, what people would consider small exit. And there were people who were non-founders that made 6 figures on that exit, even though it wasn't a huge exit. And they did so because there wasn't a bunch of money raised. So the money, went around. And it was a very fast exit. Like it was a year, well, sort of a little hairy, a little complicated, but, very short window of time to this. And so again, it's all relative. But the most important thing is people scratch their heads about this stuff all the time. And they're trying to say like, how do I avoid dilution? How do I avoid this? And how do I get more options and all that stuff? From my perspective, there are 2 things that are the most important. One is finding a company that's going to go somewhere. And I do know people in specific like IC sales roles that were very early, like pre-Series A, at companies that ended up going public and becoming very big winners, that actually made 7 figures as an IC sales rep. So it happens. Those are a lot of winners. Absolutely. Those are a lot of winners. So that's one thing. But the second thing is really, and this is impossible to pinpoint, but it's understanding the gamble that you're taking. And most founders don't even understand the gamble that they're taking with each round of funding, right? So think about, even from a founder perspective, right? Let's say that I found a company, I own half of it, and I have millions of shares. If that company sells, if I raise no money and somehow that company sells for $10 million, which would be considered a very small exit, but still successful, but small exit by today's standards, I'm making millions of dollars.
Difference. Yeah, big difference in that case.
Right? I'm making millions of dollars. But as soon as I raise, I might raise a few million to start. That's one level of risk. I go up to the next tranche, and the way that VC has worked over these last years, and I do want to make sure that we talk about this economy and what's changed and inflation and interest rates and all that stuff, because it is absolutely pertinent to the discussion and nobody really talks about it except for the guys on the All In podcast who are super, super fucking smart. And I just shout them out all the time because I've learned so much from them. But anyway, the way that VC typically works is you start with you raise a few $1 million. And then if you get to the level where you prove that you have something and it could actually be the rocket ship or whatever, then the leaps are so big. It's like the next round is minimum $10 million. And as soon as you take that $10 million, the only way anyone's making any money at all is if the company is worth 20 million or more when it gets sold, right? It doesn't seem like a huge leap, but it's these things, none of these things are guarantees, right? And so people keep going with these things and they keep loading up, and you'll see this, especially if you look back. You might be at a company today that's done it. You might look at companies that over the last 5 years, they announced their $35 million, series whatever round, or their $70 million series whatever round. Each time the risk is getting larger, and your chances of walking away with money are next to nothing unless the company can continue to multiply aggressively from there. And the bet, of course, that investors are making is that it can.
And effectively, if you're going to work at those places, whether you know it or not, that's the bet that you're making. But one of the questions that I think it might have been Dale had, no, it wasn't, it was Zach. Zach, can you ask your question from a while back? I think it's kind of relevant to where we are right now in the conversation. Zach Heineck.
I asked no question, Scott.
Yeah, you did. It's at the very beginning. You said talk about how to negotiate, and speak. How do you speak to equity at the very beginning when you're
yeah, I guess it was that, even kind of piggybacking off Alex's question of even starting off from the individual contributor standpoint of are you in a worse standpoint?
Yeah, whatever works. No worse on my side.
Sorry. Are you in a worse standpoint of negotiating that initial equity package from an individual contributor standpoint versus if you're then waiting to how you prove yourself and then move up to management and then kind of renegotiate, or when you're kind of first having that ask for an initial equity piece, how are you then kind of making that?
I think your best opportunity is more than one place. Absolutely, your number one opportunity is the first offer, even if you're an IC, whatever, right? Because you don't know if there are going to be more options later, what's available, what the situation is. Not to mention that there's a strike price. It's another thing we didn't cover. Again, if you go back and look in the video library at Aspireship, you'll see this, it was very structured. I'm not going as structured, with this, but in the beginning, your stock options, they have a they have a strike price, and it's basically a price you have to pay to get the option. In the beginning, it will be smaller. The company's value grows, it will get larger. And so even if you get shares later, you might have shares in the beginning where your strike price is a penny, and then 3 years later, your strike price is $2. And so it's just a big thing. I see comments about founders trying to underpay pay you to give you shares. This is all personal preference, right? I think it's important that you're making the wage that you believe you need and want and deserve at your point in your career and all of that stuff. And so you need to negotiate that, independently. However, I will tell you from personal experience that I had a very, very early employee at a company where, and he was very, very junior at the time he was coming in. He didn't stay junior, became a very important part of the company. But in this very, very early days, I asked the question, what's more important to you, cash or equity? And he said, cash. So I said, okay, well, clearly the equity isn't that important. So we didn't give him that much equity. He could have had more. If he articulated, he didn't necessarily have to give up cash to get it. Now, that's always an option if you want to be aggressive about it. But what he essentially had to do from my perspective was to say, look, I need X. I can't live without X. It has to be, this amount, whatever. But I really believe this can be something. And so I want to know whatever I can do to earn as much equity as possible now, later, whatever. And when you say this kind of stuff, yeah, totally get it, Dale. When you say this kind of stuff, it just inspires the person on the other side of the table. If you're at the early stage where it's like the founder and they can make these calls to say, hey, you know what, let's give them some more, right? Or let's structure it a certain way where, we talk about, progression and keep that in mind because I know it's important to them. When you have employees, and this has happened to me many times, where you get the impression that they're kind of like, whatever, I don't even know what this equity even means. And I don't know, just give me my money. You're like, well, great. It means a ton to me. It's blood, sweat, and tears. And I think that this is going to be worth X amount, or whatever someday. So I'm not going to just dole it out to you. I'll give you a small amount and I'll give you what you ask for. Right. So that would be what I would say. And then of course, as each turn, when you look at bumps, if you get a promotion or whatever, the most important thing from my perspective is asking for it. And are there opportunities? How do I do that? I'm a believer in where this company is going. I want to have the people that I know, ICs included, that have accumulated a lot of equity are the ones who are very proactive about it and make it known that they care about it.
No.
Okay.
Go ahead. No, go ahead.
I saw a question about vesting, cliffs, and ways to approach them. So one of the things that I glossed over is that, so we go back to the beginning, found the company, you have a certain amount of shares, right? And then you set up your initial stock option plan. When and if you get real investors, and when I mean real investors, I don't mean angels, even though they are real investors, you get institutional investors like venture capital firms. There are a certain set of standards that you, unless you have an immense amount of power, you essentially have to agree to these terms. And that means that you have some standard things, like everybody's on 4-year vesting. There's no acceleration except for the founders, and I'll explain what each of those things mean. So what vesting is essentially if we say to you, hey, you get 100,000 stock options and here's your strike price. Those options are essentially promised to you, but you only earn them if you stay at the company for a period of time. And the period of time is typically 4 years. And the way it works, and this is the standard stuff that the VCs will have you agree to, is the first year you have what's called a cliff. So if you leave the company at 11 months into your tenure, you walk away with zero. You have no option to exercise any stock options. Once you get to 12 months, that's your cliff, and you get you get 1/4 of your 4 years worth of stock options that you have the option to exercise and pay your strike price and walk away with your options. So that's what the cliff is. Once you get past that year, the standard thing is every month you vest. So it's 1/36. So 1 month out of the 36 months that remain on your vesting schedule, you get that little portion every single month for the remainder of your tenure. At any point, and this has happened with me where I've issued more to people even before their 4-year vesting is up, where I'm saying, hey, you know what, I want to give you a raise, or I want to give you more shares or whatever. And so, here's new ones. And then you start a new 4-year vesting schedule for the new ones, on top of it. But that's the way that cliffs work, and that's the way that vesting works. Acceleration. So what does acceleration mean? So this is especially important for anybody that is going to be in a senior leadership role. It is very difficult to get any type of acceleration if you're not in a senior leadership role, but if you're like a VP of sales or something like that, there are things you can do, single trigger or double trigger acceleration. Essentially what that means is typically it's triggered by a change of control. So if the company sells, you get all of your shares vested immediately. So as a founder, that is something that it's like, there's no world in which I don't have acceleration in the event of an acquisition or change of control, right? Because that's a very easy way to get screwed out of stuff that could have been, owed to you, right? Single trigger for VP is unlikely. Double trigger is typically the change of control. So like company sells and they do something to change your position. So that's how acceleration works.
Well, let's spend a little bit of time on this, because I want to give a little bit more context perhaps for double triggers. So change of control would be Corey buys such and such company. So whatever you're working right now is now owned by Corey. That would be like a single trigger. A double trigger could be all sorts of things. It could be a title demotion. So if you're a VP at one company, you get acquired by a larger company and you're no longer a VP and now you're a director or a manager, that could be the double trigger that gives you a automatic vest. Another one that I negotiated. I live in Austin, Texas. I get purchased by Corey's company in Arizona. Corey says, you have to relocate to Arizona. I say, fuck you. That's the double trigger. The double trigger is if I'm forced to relocate or commute more than X amount of miles to work, that could be a second trigger. So there's all sorts of things like that you can kind of negotiate, and we could probably brainstorm on and create a whole list of. But those are a couple off the top of my head that I had built into some of my contracts previously. So hopefully that's a little bit more context on like what could be a double trigger. That's a great point, Dale. Well, like collaborative Google Doc on things people have used as a, second trigger. Another one that I negotiated, I just remembered, it was title stayed the same, but suddenly I had a boss. Like if I suddenly had to report to a CRO, that was my secondary trigger. Like, I don't care if you buy me, but I get to stay in charge. Oh, I'm not in charge anymore. I fully vest.
Do you have to have those all written down like in the initial contract?
Yes. Like day fucking one.
Yeah.
Yeah. Typically what you would, sorry, go ahead.
I was just going to say, like, you go to negotiate a contract. Hold on, I get a Google Doc out. Let's put all these pieces in there. Let's stick in.
Yeah, that's all before I ever start. Because you got to think about the context. Like, if Corey is my boss and we've raised and whatnot, and I'm in the middle of working for him and we all start to see this is going somewhere, there's no incentive for him to like give me this double trigger. At the very beginning, when Corey's idea and product is nothing but a fucking dream, founders are more willing to negotiate these kinds of things. So from a strategic perspective, and this is going to sound harsh, but it is what it is. The time for me to extract more value and take advantage of the situation is early on. I'm in a stronger position of power to negotiate when Corey has 0 ARR than when he has 25 million of ARR and a litany of people that he reports to in different VCs and whatnot. This is one advantage of going very early at startups.
100% to that. This comes back to the whole very early at startups thing. So what happens when VCs come in for the first time is they're going to say, hey, here are the ways that it needs to work. And they'll use the excuse as well. And this is a real thing. They're not BSing, but it's true. They're like, well, if we raise more money later, this could be a blocker for other VCs if we don't do it this way, do the standard things and stuff like that. And so that these are some of the ways that these things get done. But if you already have an agreement with someone, you're like, well, look, I'm going to lose Scott if I can't carry forward our pre-negotiated stuff from before you were involved. So to say, okay, well, we can do a carve out for Scott, and Scott's going to keep his double trigger. But everyone going forward, there's going to be no, no stuff like that. I will say one other thing, and only if Scott keeps the beard. I will say one other thing, and you can't count on this. I don't actually know if anybody else ever does this. I have to imagine somebody out there is doing this, but basically, I've done something, and this is stuff that I don't even have in writing for anybody currently, but I did something for past employees and intend to do it again, where they did not have the acceleration built in because it just wouldn't be normal, especially for ICs and stuff like that. And I accelerated all their stuff when we got acquired as part of a deal. I had to give up some of my own stuff to do it and founder stuff to do it and get investors as well to agree that this was okay. It's effectively dilution. They get a tiny bit less money. But it was like, hey, this is something where like we're selling earlier than we planned, and I don't want them to walk away with nothing, and they can walk away with something. So, there are situations where you could get some of this stuff kind of gifted to you essentially, but it's probably not going to happen. So you definitely want to go early and, get as much stuff as you can. And the last thing I'll say is you're never getting any of this stuff as an IC. You could get a super, generous founder who will just do it, at the last second, but you'll never get it like papered as an IC because it's just not normal.
Agreed. 100% agreed. There was, shifting gears a minute, there was some questions early on. Dylan had a question about tax implications, for example. Dylan, you want to take yourself off mute for a second as we shift gears?
Yeah, definitely. One thing I've been trying to figure out and understand and learn online is like this AMT. It just seems like something the interweb tries to scare you with, but maybe it's not a critical part of what you should be focused on unless you're paying 6 figures for shares. So like, for example, like an individual contributor, say somebody like director level, maybe even VP level, like, can you talk to more about like when you should be concerned about AMT? Do you need a tax advisor? Would you recommend one for like a simple purchase of some shares? Your first time, let's call it. Is that helpful? And let me know if you want more clarification.
Yeah, so I'll give the typical answer that everybody on the planet's going to give you, which is I'm not a tax advisor and my advice means nothing. So go talk to a tax advisor. Typically, and I know you're talking about purchasing, but I just want to point this out. If you have options and you're staying with the company, you're not leaving the company, you are not required to exercise your options. And when you have not exercised your options, there are zero tax implications. It's just sitting there. It's like a thing that hasn't even happened yet, but it's an option to do later. When you leave, that's when it gets hairy, because then you have to decide, am I going to exercise my options or not? If your strike price is low, which again goes back to joining early, your strike price is low, you exercise the options. I don't think that you have, I think it goes, I don't think they get reassessed. I think it's like the price that you paid would be what again, not a tax advisor, I think that's what IRS would look at. So if you pay like a penny a share, they'd be like, oh, okay, you acquired this stuff for a penny a share. I don't know what it's worth, like whatever, it's this private company, like here's the records of it. And that's what would be, you know, the sort of tax assessment on it. But I don't know for sure on that. When you get into the later stage companies, that's where it gets super hairy. The other thing I want to mention, and I can stop and I can go later on this if you all want to go further into this part about exercising options, but I really do want to talk about the economic climate and what it's doing to valuations and how that will impact stock options, especially in a late stage company, because it would be a shame to spend all this time and not cover that. Should I go there, Scott, or is there other things we want to get into on this part?
I think that's a good place to go. I have just experienced that. It does not feel it does not feel nice. You feel, Dylan, do you feel satisfied with answers to your question? Is there any other, I mean, there's so many different aspects of it, but did you get what you need?
Yeah, definitely. No, it's helpful because it was an early stage company and it's not a ton of money that it would cost to exercise the shares. And it's like, it sounds like something not even to worry about. Like they're still raising a Series A. So it's like, don't worry.
Oversimplified answer and an obvious one. The more money that's at stake, the more you should find an expert advisor. We're talking about $500, who cares? You're talking about $5 million, you probably want to talk to somebody.
Right.
Yeah.
Yeah.
So the part I want to talk about, and this, I didn't grasp this to this level until this year. This year is like the craziest year in the history of my life as it comes to this stuff. All right. So I do want to spend some time talking about it. All right. So I've been warned not to go too deep into the rabbit hole, not by Scott, but by others. Don't go too deep into the rabbit hole on this, right? But here's the basic setup. So you all know all the stuff that's gone on this year with like inflation going out of control and then interest rates gone up, all that stuff, right? Okay, so where this starts is, and we'll forget about talking about why inflation is where it is, all right? Let's save that for a different discussion. But with inflation going up, the Federal Reserve, who controls the interest rates, that anybody who lends you money, they have to look at the interest rate set by the Federal Reserve and then they mark it up. So like on a mortgage, if it's 5% for your mortgage, the Federal Reserve rate was probably like 2% or 2.5%. They marked it up from there, and that's why you get 5%. Okay? And so during the pandemic, and actually for a long time before that, interest rates, the Federal Reserve's rate was like 0% or close to that, like next to nothing. Those are designed to stimulate the economy when interest rates are that low. When inflation got out of control, one of the only real levers that the Federal Reserve has to play with to try and slow the economy so that inflation isn't crazy is to raise interest rates. Okay, why do we care about any of this? When you read articles about this, they're going to talk about, oh, well, borrowing costs get higher, whatever. Okay, that's fine. But the thing is that with interest rates as they go up, that means that investors, whether it's stock market investors in public market or private investors like venture capitalists or PE firms or angel investors or whoever, they then have a choice to make between, do I take the guaranteed interest rate, let's call it 5% on my money. If I got $1 million to play with, do I want to make 5% and virtually risk nothing? or do I want to go risk it and put it into stocks, put it into private companies that might not be worth something? I have to make that determination. And so as soon as that happens, investors then say, okay, if I'm going to put money into even a public company that's growing and proven and all of that kind of stuff, I need my return to be X, right? It needs to be, if the interest rate's 5%, I need it to be at least 10% for me to take the risk. If I'm going private company, I need to be at least 20% a year, whatever it is. So the bar just raises higher. So the reason that this matters so much for all of you and anybody who's working in startup land, tech companies, whatever, is that the way companies are valued typically is a multiple of whatever their annual recurring revenue is, or annual revenue, right? So if the business is doing 10 million in annual revenue and it's growing really strong, we might say the multiple on that's 10 or it's 20. So the company's worth 100 million or 200 million. When things kind of got out of control, there were companies that were raising rounds at 100 times ARR. No joke, this is happening because they were the hot company. They were going to just go crazy, whatever, right? And so that's how things have gone. Damas Palpatia, I think I'm saying the last name right. He said this like 6 months ago or something on the All In podcast, and it blew my mind. He said that a good rule of thumb is that for each percentage point, so 100 basis points, that the benchmark interest rates by the Federal Reserve are raised, a company's valuation should drop by 20%. So this year, the Federal Reserve went from 0 to 4%. And if you look at a lot of tech companies, they're down like 80% this year.
Do you see what Corey just said? He just said 80%, and I just gave one personal example of mine, which was 70% dip, which he probably didn't even see that I typed up because he was on his thing. So we're simpatico. Yeah.
So what does this mean for you? Well, it means, if you had a lot of money, especially in tech companies, and I'll tell you why in a second, in the stock market, like I did, you lost a lot of money this year. But separately from that, let's say that you joined, and I'm not going to name names since it'll be recorded and people look at it, but let's say you joined some like mega unicorn company last year, and they're like, we just raised $1 billion at a $7 billion valuation, and we're really cool. And you're like, and here's your strike price, which is whatever, $30 a share or something you got to pay to get these shares. The company, even if it doubles this year, is probably not going to be worth that again for multiple years, if ever. And yeah, ever. And
maybe ever, because humans are stupid and we repeat the same mistakes over and over and over. So if you hang on long enough, maybe.
But they won't hang on because investors are impatient, and especially the ones that put in gobs of money. They're like, oh shit, this is not working out. Give me my money back as soon as possible. Just sell to private equity or sell to Salesforce or whatever, and let's get out of here, right? If they've done these things. The question is, down rounds crush your strike price. So your strike price, this is important. The strike price that you get at the time when they're issued to you. So back to the question of like, hey, I'm an IC sales rep and I'm getting my options for the first time and I have a strike price. That strike price will never change. So you lock that in. The company's strike price will change, but your shares are issued to you at that price at that moment, even if you don't exercise them then, all right? But later, if you get more shares, those will be at a higher strike price. And so the issue where this screws you on the strike price side of it, so you remember the whole liquidation preference stuff I was talking about? So that's one way that you can get screwed out of getting anything from this stuff. But in addition to that, if your strike price is high enough and the company's valuation falls substantially enough at exit, you might pay in your strike price what the company's shares are worth per share at the time of exit, even if it's worth like $1 billion or something, in which case, again, it's worth nothing. So these are just things to
We got
to keep
there's
in
a
mind.
there's a couple tag along questions here. Dylan just asked, so if you got issued in the bubble a higher strike price, the company's value goes down, buying them is now not worth it? Can you try
It depends.
I know.
It depends. So here's the funny thing about strike prices. At least for early stage, I don't know enough about this ratio at the late stage. At the early stage, and I just very quickly previewed this in that video I referenced to you guys before to see what Jake, my VC and lawyer, said. Typically, whatever strike price you're getting is maybe like 1/8 of what private investors are paying for preferred shares in the company. So strike prices are artificially low. And there are some reasons for that, but it's actually like a really, really good thing. And I don't even know how it's possible, but it's basically, I think part of it is because companies are just inflated based on, you know, forward-looking, you know, growth and all of that stuff. But you don't pay what the company is really worth in your strike prices, especially in the early stages. In the late stage, you might. But also, again, I would point back to this whole thing of, if the company raises at a reasonable valuation, then you really have nothing to worry about. But when they do the mega rounds, usually it's at an inflated valuation, like these 100x or even 50x, even 30x ARR. And if those things happen, the reality may be very different, where like the company exits and they get 5x ARR. And if they raise at 50x ARR, I don't care what your strike price is, you're not making any money, right? Not to mention the whole liquidation preference issue with all of that stuff. So I know it's a lot of stuff to process, but like that's the big thing. It's just understanding that there's these degrees of risk, and the more inflated, the more aggressive you get with all of it, you know, the more the company needs to reach an outsized, you know, multiple on exit for you to make money.
Corey, can you define for Brian real quick, like what's the definition of early stage versus late stage? Like, what are we talking about in your mind?
So in my mind, I'm talking about like, you know, $1 million ARR or lower. So like first couple of years of a company, first 10 people, first 15 people in the company.
Yeah.
That's where I've lived most of my life. So I'm you know, biased. If you look at like articles or like something like Market Watch, you talk about early stage companies, they might talk about a company that's, you know, doing 50 million ARR and, you know, raised gobs of money and all that.
The
stuff.
next time somebody tells
relative.
me, the next time somebody that tells me Gong and Outreach are startups, I'm going to lose my mind. They've passed that.
Yeah.
Let's be real. Yeah.
Yeah.
Mike had a really, really interesting question. Given all of this, why does somebody go down the VC route and raise money?
Well,
I dropped a couple jaded answers in the chat, but I'm curious to hear your response.
It's a really good question, and I think I'm a decent person to ask because I'm right in the middle of that, right? Where like a lot of it is about ambition, right? You do something, you, from your perspective, sacrifice everything to be able to even have a fighting chance for these things to work. And, you know, no joke, like it's a miracle for startups to go from 0 to $1 million in revenue. Right? This is not easy stuff. You're making up something that like has never been done before or whatever, and, you know, turning it into something, right? And so there's no guarantee you do that. And so if you're able to do that, you're like, all right, I did all this risk, I gave up whatever sacrifices I have, and now I've done this, you start to get these, you know, ideas of, well, it could be this. And if we don't raise, somebody else is going to raise, and then they're going to crush us. They're going to outspend us on stuff. They're going to hire better people, build better technology, all that. So you get into these things of, needing and wanting to do it. The other part is it can be done, but it is insanely difficult to get profitable at the. Oh, did you mute?
Are you still doing homework?
It is.
Cool. How'd it go?
Hey, Seth, could you mute? All right, sweet. Thanks. It's insanely difficult to get profitable before, I don't know, years and years into the company. It happens, people do it, but also get profitable and actually have something that has traction and grows and all that stuff. So you're sort of battling against these pressures all the time. So sometimes you might raise because you're like, all right, if we don't raise, we literally will go out of business and like this will not be a thing anymore. And then other times, and this I think is more, it's the other one's somewhat common, but this is, probably more common is, okay, we have this, I can see like if we just had money and time and space, we could do X, Y, Z and we're going to rule the world and all that stuff. And so people go and raise and you sort of think it's the de facto thing to do, especially once you've started and you raise something, you're on the track, you're supposed to go and do that. But you get into situations, and I would count myself in this, where you're like, okay, I've raised a little bit of money and I've gotten to a certain point, and now it's like, I would raise for sure if it was a small amount and I could just incrementally keep going. But if I have to go raise like 10 million or 20 million bucks in the next round, it's like, I don't even see how I'm going to spend all that money. And so you get into this weird thing. But yeah, it's just risk tolerance more than anything.
Other questions that people might have? Otherwise, Corey, you can keep going if you know where you're going next.
I don't. I think we've talked about a lot of different stuff. I think probably the most important thing to say is that every time I talk about this, there are more negatives than positives, and so it's natural to take away from this like, hey, there's 100 ways to get fucked doing this, right? It's like this is a high risk game. And I think the most important thing is just understanding what you're getting into and what it is you want out of it. And then try and gauge the probability of whether or not that could actually be the case. I think in terms of the positives, stock options can be an incredibly lucrative thing. If you're with the right company, right founders, all of that stuff. And especially if you go and, you grow responsibly to some regard. You do something where you're not trying to necessarily get to $1 billion exit, but you're like, hey, we're going to raise a few $1 million and, within 5 to 6 years, maybe we'll sell for 30, 40, 50 million bucks.
That's a good.
Everyone can make some good money.
That's a real good perspective from a founder. If I may, let me talk about the perspective from somebody who's going from this individual contributor to VP and perhaps cutting the cord from VP the way I've done and going more of an advisor consultant kind of route. Like I said before, you're an individual contributor. To me, like, unless you hit the lotto, you're going to get a brand new car. That's an expected kind of return. There's nothing wrong with that. Director kind of level, you get a down payment on a house. VP level, you're fishing for mid 6 figures to 7 million or 7 figures, $1 million bucks, whatever. Right? It's pretty amazing to go through that journey. And you're just doing your job, and then all of a sudden you got a $50,000 check or a $500,000 check when you've been an operator at a place. I got a $485,000 check a few years ago from one of my VP of sales gigs. This was about 6 years or so after I stopped working there. I was the initial VP. That was a lower amount than I expected because they didn't do as good after I left. But I got this check and I'm like, oh, wow. Biggest check that I'd ever gotten up until that point. Pretty amazing. The company that I mentioned in the chat, it's still poised to be the largest ROI that I get, well north of 7 figures, multiple 7 figures. It used to be worth 8 figures. So I'm doing the mental mind fuck of like, oh, I just lost $10 million, which is dumb of me. I know it's dumb because I should be looking at it like I might make a couple $1 million. Now I'm not in that world anymore. I'm not an operator. If you're able to do this operation thing a few times, get good at it, maybe get an exit or 2 like this, and then get out of that world and get into consulting, advising, or whatnot, or being an ambassador even these days, you can grab shares in lots of different companies and lots of different places. And this is a strategy that I have deployed. I just used to think of it like a roulette table. If I go to a roulette table and place $100 on one number, my odds suck. But if I place $100 on a bunch of different numbers and corners and all this kind of thing, my odds are going way up. So I'm an advisor to Evan's company. I get 10,000 options. I'm an advisor to Dylan's company. I get 5,000 options. I advise Eric Davidek's company. I get 25,000 options. It's all over the map. I'm covering the roulette board, right? I'm giving them help, advice, whatever. I'm also getting paid cash for doing these things. So I'm getting paid now with the possibility of something in return. So now you imagine a world where, like, out of nowhere, this email shows up in your inbox and it's like, hey, an acquisition has occurred. Sign this because you're about to make $45,000. Sign this because you're about to make $26,000. Those moments are insanely gratifying. They really are. And, you know, if you've built a good career for yourself and you can get into this kind of position where you have all these different things floating around, you kind of can start to expect one of these things to happen like once or twice a year for me right now, and maybe once or twice a quarter as I get a little, you know, older and more mature in what I'm doing right now. So it can be quite lucrative for sure. There are positives. It just, again, trying to highlight how all this stuff works and implore everybody to educate themselves on this topic as best they can, right?
Yeah, understand the game. I mean, that's the biggest thing. Just understand it as much as you can, going in, eyes wide open. And, you know, one of the ways I thought about it in the past is you look at what you want or need or whatever to make what your goals are, you know, per year. You just average it all together. Right. And so it's like, well, if I want to make X 100,000 per year, I get what I get in cash doing my operator roles and whatever it is that I do to earn money. And even if it's not as robust as what Scott is talking about, once a quarter, once a year, once every 5 years, you have a little hit that comes in. You're like, okay, once every 5 years, I got whatever. Let's say you had that $500,000 hit, $100,000 a year for the last 5 years that you made, you know, through that, right? And you get to tack it on to what you do. So, yeah, so I think it's cool. You also can just learn a ton by being involved in some of these situations. But I think the thing that Scott and I both would like to see for anybody watching this is don't wait until you go through one of these life-changing events to learn about it.
Yeah.
Because you go through it and you're like, next time I'm not going to do that. I'm going to do it this other way. It's like the next times don't come that frequently. So
that's true.
Educate as much as you can.
Yeah. Any last questions for Corey before we jump and thank him for his time and thank Sendoso for sponsoring Tequila Tuesdays as usual.
I've got one.
Go for it, Lori.
Hey, Corey. Is there a
Hello.
way, I'm in the middle of a raise going for a Series A. Is there a way I can help and protect some of the people that have been here building this before we start bringing in a lot of this outside investment and like protect their shares?
So I think the best way to put this. So the protection really comes in your confidence level that you're going to multiply the value of the company. Because that is the single biggest thing. So let's say you get the Series A and it's like 10 million bucks and they're going to value the company at 40 million bucks or 50 million bucks or whatever the number is. There's a significant chance that you never even reach the valuation they are setting on the company today.
Yeah.
And so that is the biggest downside risk for your people. Anything else, there's not a ton you can do other than if you have a bunch of stock options to play with and you're feeling extra generous, you can issue some of them to your people now. It just, increases the amount. But again, one of the biggest things, and I don't want to share too much detail since it wasn't my company, but one of the biggest things was being part of some of these things that Scott has mentioned, where the company raised a bunch of money, the valuation was like this, then the company actually grew substantially over multiple years and was worth less than when they raised the money years back. And all this money washed out in liquidation preference. Just a ton of money. It was like half of the exit value just went up in smoke like that. So that's the biggest thing. That, and you can raise less, but generally speaking, unless you're in just an extremely powerful position, which is hard to do, especially in this economy with startups, you're probably going to go with, if investors want to write a 10 million check, you're going to take the 10 and not 6 or 5, right? Because they're like, I once had an investor say to me that they needed to pass because it would be difficult for them to write smaller than a $20 million check.
Okay, yeah, that's real hard. Okay, just cut it in half, boys. Jesus.
Well, there's to be fair and defend them, there's certain firms that only write certain size checks that only participate at certain times.
I know, but I'm not looking for that, Lise.
Yeah,
I'm looking for other stuff.
I know.
Corey, one more thing. Planning and building my ESOP right now for my team and looking at future growth, like who I'd be adding in and how to make sure it is as fair. Yes, we're haters. Thank you, Scott. How it can be fair across, new folks coming in, whether that's, hey, if you're a VP, there's a certain multiplier that plays here based on your salary multiplier, whatever valuation is out across all the parts of the org versus, we're playing with all the levers. Do you have any advice on the levers that I'm pulling here?
So the way I think about this is I always look to the end, right? So I try and visualize, all right, here's where I hope we're going. So 5 years from now, if Lori's on my team and Lori did this and did that and was awesome and whatever, how would I feel if Lori walked away with X? And in Carta, do you use Carta today?
No.
Okay, should totally use Carta. You'll need to.
You'll
there's
need to.
probably other things, but Carta's the gold standard. Carta has a thing called scenario modeling. And you can actually go in and say, all right, 2 years from now, the company sells for $30 million. What does every single stakeholder get? And you can look at those numbers and go, how do I feel about that? Like when I tell Lori, great news, you sold the company, here's what you get. How do I feel about that moment? that's the thing that I use to guide my decisions on it. But you always give heavy preference to people that were there before, because that is the riskiest time. You know, when people come in later, they get really nice salaries, they got a proven system, whatever. Yeah, it's all hard work, it's all risk, all that stuff. But you know, only the early people really get big chunks, unless they're, you know, like Scott and everybody wants them to join the company, and then they're like, all right, well, I'll have to just give Scott 1 million shares, I guess.
Did you give me 1 million shares, Corey? I'm just wondering.
No,
No,
I
he
really didn't.
I was
really,
very
really
bad.
didn't.
I negotiated very poorly. I've lost.
Yeah, you had no power. You had no
Yeah, no
power
power.
in this. But you know, maybe if you come in to lead sales, we could talk about something different. You have to fight with Christine over the,
I was gonna say, I'm
over the
telling.
throne.
Yeah.
Yeah.
Good questions. All right,
Thank
we got to jam. I'm gonna let Corey get back to his family and his job. Same with everybody else. Appreciate y'all for joining us. Hope you got something out of it, and we'll see you next time. Ciao.
Thanks, everyone. I had a good time. Hope you did too. See you later.